Taylor ham or pork roll, which is it? I don't know. This is the IssuesWatch podcast. Hello, and welcome to the IssuesWatch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm the partner in charge of accounting and auditing at Sobel & Company. These A&A episodes qualify for Nano CPE. If you're interested in earning CPE credit for this or other episodes, hit the pause button now. Head over to njcpa.org/nano to find out how. As usual, quick disclaimer, the views and statements expressed herein are my own and not necessarily those of NJCPA or Sobel & Company. Okay, so let's get into some interesting stuff that's come out recently. Finally, with the FASB, finally, they said that they're going to look into crypto accounting. Now, if you notice remember from previous episodes, we had said that the FASB has remained silent on this. The AICPA came out with a guide for accounting for crypto assets, but the FASB remained silent, kind of left it to the AICPA or international. Well, finally, the FASB voted to consider setting clear rules on accounting and disclosure. This is after an agenda consultation with investors, companies, academia, 500 different responses that said you really need to look into this because the current accounting model, which I'll talk about in a little bit, the current accounting model really doesn't fit well with the business community. This is also follow-up research that they performed that found some common areas, including contracts, including crypto assets that may contain derivatives. You've heard me talk about derivatives in the past. If they start connecting with this with derivatives too, it's just going to be an absolute mess. But let's see what they start doing. Borrowing and lending on crypto assets, and the other area they found as a common thread was crypto assets and mining activities. Now, what I'm just seeing or hearing is people that are just buying crypto assets and trying to put it on their balance sheet and how to account for it. Just very simple, but it seems that they're starting to overcomplicate it before they address the simple area. But again, those are my comments. Now, if you remember from previous discussions, the current accounting is that it gets put on the balance sheet as an indefinite life intangible. Now, you know what happens with indefinite life intangibles. You have to review it at least annual for impairment. And if it is impaired, goes down in value, what happens to crypto? If it goes down in value, you have to impair it. And what happens if it comes back up? Nothing. Under current accounting, indefinite life intangibles, after they're impaired, you cannot recover that impairment. So it just sits there and you don't recognize an increase until you actually sell it. So you can see where the business community is saying, this is not working with our model. Some of the other things to consider is nonprofit organizations are starting to get contributions of crypto assets, Bitcoin, etc. They're saying that they could be treating this similar to other commodities, which would be interesting. And the last thing I'll mention is the volatility, which is the big concern that, of course, the FASB has. The DOL has concern about this if people try and put it into their 401ks, completely separate topic. But they've also seen that some SEC companies have started commenting on their earnings, excluding impairment from crypto assets and stuff like that. And the SEC came out and said you can't mention that as a non-GAAP measure. So there's a lot of discussion that's going on with this, and I think the FASB really needs to address it and give us some direction and guidance. Whew, okay, on to the AICPA. AICPA came out with a technical question and answer, TQA. If you don't see these TQAs or other guidance that they put out where it's a lot of discussion and Q&A, I strongly recommend that you look into it. They're really, really helpful. The one that just came out, 9165.01-3, is auditor reporting when the entity issues their annual report subsequent to the issuance of the financial statements. You're saying, what the heck does that mean? Okay, so you issue your financial statement, your audit report with the financial statements, and then later on the company issues a full audit report. Think about public company, think about nonprofits, that they issue a report to contributors to the community, and they include your audit report in there with the financial information. What happens if they issue it subsequent, which they have to do, but there's information that may affect or would have affected the report. What's the auditor responsibility? And it was two simple Q&As. The one, they say that the auditor really doesn't have any responsibility on the offset to do anything unless they found that their report was wrong, the financials were wrong. But if it's something that happened subsequent, then on the outset they generally don't have an obligation, but they can, if they choose, to reissue their audit report, and they could dual date or just redate the report. So it is an interesting Q&A. In line with what these type of Q&As that are issued, the AICPA issued one a long time ago. It's called TIS 9110.19. And it's information on comfort letters and third-party verification letters. And I know everybody just turned me off and said, I don't deal with that. I can bet most people do that are in public account, in the public sector. These are the letters that the banks, and if you're a banker, please stop sending these, the mortgage companies. If you're a mortgage company, please stop sending these, that request information about a company, an individual, a taxpayer. We just received one the other day, and the letter said, we need for you to tell us that they own, this individual owns X percent of the company, and if they take out $92,000, it's not going to affect the company in an adverse way. They wanted us to put that in a letter. Now, the AICPA came out with some really, really good guidance. If you've ever attended any of my non-attest sessions, you know I close on this. And I don't know if the message is getting out enough, because I know that practitioners do these. And the only thing I'll say is on the outset is don't just provide a letter. I can guarantee you're saying something that you should not be saying. If you're giving any inference of attesting to something, you can't do that. You cannot comment on solvency. Me saying that the company will not be affected by them taking out $92,000 is an indication or direction towards solvency. I'm saying that the company will be okay. How do I know that there's not going to be other things that's going to affect the company? Okay, look those up. If you need any more information on it, reach out to me. I have a lot of information. They came out with a peer review report that talked about audit quality, and there's a lot of good information in that in that report. They identified for audit quality and what the peer reviews felt, if they've changed, if it's improved significantly or moderately in the area, or if it hasn't improved much or no improvement at all. The areas that had significant or moderate improvement, this is what the peer reviewers saw, are EBP, single audit, and that's probably a lot because the AICPA has focused on this, the peer reviews have been focusing on it, so firms have been focusing on it. Quality control, documentation. Yes, finally we say that it's improving, but we could do a lot more in that area. And risk assessments. Well, we've been beating risk assessment up, reading it up so much, they came out with new guidance on it. And limited to no improvement, this is a tough one, internal control. I find it hard that internal control is limited to no improvement, which internal control feeds into risk assessment. So that was interesting. Anyway, at least interesting to me. Engagement acceptance. I think this is going to be one of the hot buttons coming up soon, engagement acceptance. They're really being very critical about the way firms are accepting clients and documenting it and considering different things about the clients. And the final one, which you can expect, is revenue. New pronouncement came out. We didn't address it properly, possibly in the audits, reviews, and sometimes compilation. Even if you have a compilation, you should document their revenue process if it's in accordance with GAAP. I can imagine that leases is going to be one of the big areas under peer review when the lease pronouncement becomes effective for private companies. Some other areas to consider, potentially more single audits due to government funding. One of my clients, who was a airplane parts manufacturer, received a government grant and they may have to have a single audit done. Never had one before. The company's been in existence since 1960. The risk assessment with the SAS 145 release, auditing evidence with the release of SAS 142, and auditing estimates, the big concern, again, with the lease standard, because there's going to be some considerations. So reason why I brought that up is just to say that this is what the peer reviewers are seeing as it relates to the audits. You know, when they go out to look over the information, and the peer reviewers are had a tough time trying to keep up with all of this. So With that, I want to address one last area. I'm not trying to push for the membership, but the Center for Plain English Accounting. If you're not a member, I would look into it. It's through the AICPA. It has some really good information, some really valuable information. They issued a compensation series where they talk about a bunch of different compensation structures and provide some guidance. This issue discussed a bunch of areas, including profits interest units, phantom stock, bonus time, compensated absences, deferred compensation arrangements, rabbi trust arrangements, and restricted stock awards. Now, this is not a tax session. This is about the accounting for those areas. In closing, I'd like to remind you about some upcoming NJCPA events. Last call. Register for the NJCPA Convention and Expo, which is returning in person at the Borgata, Atlantic City, June 14th to the 17th. Frank Boudelet and I will be presenting a session and recording a podcast episode while we're there, so come on down and watch a live recording. And you can learn more about accounting for auditing cryptocurrency and digital assets at a 2-credit webinar being offered on July 11th, September 13th, and numerous other dates. Register for these events and more at njcpa.org/events. And be sure to join the NJCPA Accounting and Auditing Standards Interest Group at njcpa.org/groups. Thanks for watching and listening.